Hello everybody and welcome to the Like a Tortoise channel. Today I want to talk about one of our holdings, Evolution AB. They just reported earnings. Well, actually they reported earnings in the morning, and I spent part of my morning just analyzing both the presentation report that was released, but also listening to the conference call. And today I want to walk you through the main learnings, right? The main findings, together with some of the notes that I've taken along the way, and draw a conclusion. So, what am I doing after this 7% dump? At one point, the stock was down about 10%, and of course, because I have a concentrated portfolio, this will always any company that reports earnings and faces a big sell-off will always impact the performance in the short term. This is certainly the case with Evolution. But what am I doing as a long-term investor? Am I selling? Am I buying more? Where do we stand? And that's what I want to discuss in this video. Okay. So I took the liberty to put everything together in a Word document, as I always do, and I will walk you through some of the most important aspects of both the reports, of both the report and the conference call, and hopefully at the end of the video you will have a clear understanding of where we are, of whether you should. You will have a clear understanding of what's happening with Evolution in the regulatory environment, which has been impacting the business substantially. So the stock was down at 1.10% after the releases already alluded to. But what were the financial highlights? Okay. So what happened? So you can see that they missed across the board. That's one thing that you need to bear in mind. But also bear in mind that only short to medium term traders will focus on quarter over quarter estimates. Okay, to me that doesn't mean anything over the long term. What matters is the long term prospects of the business. But that said, the market, of course, as short term oriented as it is, it pays a lot of attention to these things. And the reality is that they missed both net revenues and adjusted EBITDA fell short of expectations. Revenues decreased by 2.4% year on year, falling short of expectations. The decline was primarily driven by significant revenue losses in Asia. The situation in Asia persists, and this is definitely a headwind that has taken longer than expected to. And unfortunately, as I will discuss ahead, management didn't provide a clear time frame on how long they think this problem should continue. Okay, which is definitely not good for me to know as an investor, but I like to see that they are doing everything within their power to actually address those issues. Adjusting, and by the way, guys, if you don't know what Revolution is or what they do, please go back to some of our previous videos, and I discuss Evolution in more detail. But long story short, they are the world's leading online game provider. So they provide online casino games to casino operators. So they are not a casino operator themselves. They operate a business to business model instead of a business to consumer model. And then it's the operators, right? The casino operators, many of them land-based casinos, that actually sell them to their customers. Okay, and they are the leading live casino operator, and that's part of the key thesis of the reasons I decided to invest in the company in the first place. Now, adjusting for currency fluctuations, revenue growth would have been 3.9%. That's a very significant difference. So you can see that currency headwinds took their toll. Notably, for the first time ever, RNG offerings are outperforming live casino. Is this a good thing? Not really, because live casino contributes about 80% of revenues, and what we are seeing is that live casino is slowing down, and at the same time, true, our NAG growth is accelerating, which is a positive, but the fact that live casino is slowing down is not really good. And so bear that in mind, because this is where I think a lot of the future value will come from, as more and more countries open up to regulations, which I think is going to drive long-term growth. Operating profit decreased 21%. Look at this slump. That is substantial. While the operating margin fell to 58% from 65.5% a year ago. Adjusted EBITDA declined by 5.3%, again below market expectations. The EBITDA margin, while lower than Q3 2024, improved sequentially versus the first 9 months of the year, thanks to cost controlling progress in other regions. Let's show you this. Let's show you what I mean by that. Take a look at this. This is the summary of the third quarter and the first 9 months of 2025. So if you compare the first quarter of 2025 to the first quarter of 2020, the third quarter of 2025 to the third quarter of 2024, you can see the percentage difference. And look at that, nasty, right? So it's just, oh man, it's just all negative. Not good to see. Revenues declining, profitability took a sharp drop as well. But on a positive note, as I highlighted above, you can see that adjusted margin that was down quarter over quarter, right, from 71 down to 64. It actually improved if we compare this quarter to the first 9 months of the year, right? So it improved from 66% to 66.4%. Okay, so let's continue. Management reiterated. Oh, and yes, so this was basically due to cost control in progress in other regions, and we will discuss cost control in greater length later on. Management reiterated full year guidance of a 66-68 EBITDA margin, which is very good. So indicated confidence in margin recovery despite short-term pressures. You know, it's incredible if you ask me, because even against the backdrop of all these negatives that I've been pointing out to, it's incredible that Evolution still manages, still can maintain this level of margins. And you can see that. Look at this. Adjusted EBITDA in adjusted EBITDA percentage. Look at these margins. 69.3%, and now even though they are facing, they had faced declines, they are actually improving. Certainly, if you compare them with the Q1 2025, where they were 65.6%, they improved to 66.4%. These are stellar margins. Stellar. Okay, very, very good. And and it goes to show how it's part of the moat, right? So for a company to keep these margins is because they don't have a lot of competition. Let's put it that way. The quarterly margin decline was primarily due to FX headwinds and higher personnel costs, reflecting studio expansion in new table launches. This is true. And you can see that headcount costs increased. In fact, if I go here, where is this regulated now? Operating cash flows, balance sheet. You can see that headcount and periods. You can see that there was a year-over-year growth of 4.2%, and this is exactly due to the fact that they are continuing to expand. And then they always have to do that, right? They always have to find this balance, this balancing act between expanding but controlling their costs at a time when revenues are actually slowing down. In fact, they are declining. Okay, so cost control is important, and I like to see management executing on that. Also, let's continue. Interesting, despite the steep drop in operating margins, the company still managed to expand EBITDA margins sequentially, highlighting strong cost discipline as I already discussed. Operating cash flows for the first 9 months of 2025 declined year on year, driven primarily by lower profitability. Look, there's nothing, it's just what it is. So if I go to operating cash flows, let's go to the cash flow statement. You can see cash flow from operating activities, and you can see that they increased. If you compare this quarter to the same quarter in 2024, and this is from operating activities. But if you compare that, look at this, from January to September 2025, that was 958 million. And then from January September 2024, it was 971 million. So there was here a decline here compared to the first 9 months of 24, and this was due to that profitability decline that we discussed as well. And yes, so let's go back. The company announced a 500 million share repurchase program, which I like to see. It creates more shareholder value by reducing the number of outstanding shares, right? They realize the stock is cheap and they are buying back shares. Very good. I like that. Operational highlights. So Asia remains the biggest challenge, guys. So we have cybercrime there, which continues to weigh on performance. Even CEO Martin Carlson commented, we continue to combat this that has impacted our business in the region for far too long. And during the quarter, we didn't make the progress we had hoped for. He's always very transparent. And once again, he says that they are not happy with the current quarter, primarily due to the situation in Asia, because interestingly enough, you can see that I see improvements across in other regions. So look at the regional update, and you can see that compared to the second quarter of 2025, Europe has improved, right? So revenue increased. The same for North America, and for Latin America, the only decliner was certainly Asia. Okay, so this is just what it is. Going back, and so the fight is a constant balancing act between overly strict countermeasures, which create problems for the legitimate end users, and end measures that are too mild, which do not achieve the desired return. So it's an ongoing battle. And in the third quarter, we went somewhat too far with our countermeasures, which negatively impacted revenue. What is he saying here? He's saying that some of those countermeasures ended up affecting legitimate end users, right? Which of course affected revenue. And I hope this is just temporary, but we will see over the ensuing quarters. The region also faces other headwinds, namely regulatory uncertainty, especially with the newly regulated Philippine market, and India, which seems to be moving towards regulation. I want to be clear here. Regulation in Asia is a positive. However, what I think is that this can create a lot of volatility and can dent sentiment in the short to medium term. But over time, this is going to create value because more players will be wanting to play games with licensed providers, and they will want to know that there is regulation in the space, right? And so I think that will be a positive. On the other side, I think institutional money managers have been a bit skeptical, have been hesitant to walk into this industry, to enter this industry with money, because it's seen industry, right? And a lot of that is still unregulated, and they don't want that. Once that once that barrier is broken, then the game is back on. The new studio in the Philippines has had a strong start, but management provided no clear time frame for a return to growth in the wider Asian region. Europe returned to growth, as I already alluded to, supported by the full effects of ring fencing. If you remember in previous videos, in quarters, I discussed the fact that management had taken proactive measures in Europe which dented revenue and profitability over a few quarters, in fact over 2 quarters actually, But now that the revenue that Europe is back to growth, what that tells you is that the proactive measures that they implemented are actually taking effect, and I like to see that as well, because Europe remains as a key market for Evolution AB. In fact, if I go here, I can show you that right here in the report. You can see that the main markets are Europe and Asia. So the fact that Asia is declining is definitely a headwind, but because Asia is the biggest contributor to revenues, okay? So in Europe comes right in second, and Europe is showing signs of growth as well. And I like to see that. I don't like to see what's happening in Asia, as I already covered. And yeah, but it's just it's what it is. So moving on, new studios opened in Philippines and Brazil, further strengthening their presence worldwide. Product innovation continues. US expansion as well. This is definitely a big positive. Higher share of regulated markets. I can't stress how important this is. One of the core reasons not to be bullish on this company was the fact that a lot of the revenues were generated from unregulated markets. Sure enough, if I go to July, September 2024, you can see that 39% of their revenues came from unregulated markets. Well, sorry, 39% came from regulated markets. Now, you can see that this number has been slowly but surely moving back up, and now regulated markets account for 46%, which is something that I like to see. And more importantly, based on what the CFO said during the conference call, they expect this trend to continue going forward. Reputation battle. If you are not aware of what happened, it's a big deal. Essentially, their biggest competitor is Playtech. And Playtech, back in 2021, apparently, paid this company, Black Cube, to fabricate false evidence accusing Evolution of operating illegally in restricted markets. And now, fortunately for us, Evolution shareholders, it appears that those were indeed fabricated claims, evidences, fabricated reports, and that, in fact, goes to show how that this company is quite. Their operations are quite controversial. Let's put it that way. But you can do more research on them if you want. But Evolution is exposed Playtech as the pillar behind that damaging report that was indeed intended to damage its reputation. It cost billions of dollars in losses. Okay, so in the aftermath of Evolution making this public, Playtech shares crashed some 70 or 80%. So you can see that because they are the biggest competitor to Evolution, this is definitely good for Evolution as well. And maybe we will see consolidation going forward. I don't know. Now, my take. So what are the main negatives? Asia remains the biggest drag. Okay, there's nothing really positive there. Management offered no visibility in terms of when this should stop, which is something that I don't like. It may persist longer than expected, but they are implementing countermeasures and doing everything they can to reverse that course. It's concerning that cyber attacks affected legitimate users, and also the regulatory landscape in India is a double-edged sword, right? It creates short-term pain for long-term gain, or certainly that's what I'm hoping for. The positives, I see resilience across different markets, right? With the exception of Asia. I see a company that continues to expand in different markets, but in Latin America with the opening of new studios. And I also like to see that the company is still has a very robust net cash position. In fact, if I show you that, if I go to the cash flow statement, you can see that their cash equivalents, right? I mean, look at that. In fact, look at the total current assets, which is enough to cover all the sum is enough to cover total current liabilities, and total non-current liabilities. So with total current assets, they could pay down all their total liabilities, which is something that I completely love to see it. So they have a pristine balance sheet, and they have a lot of firepower to continue to innovate, to expand their business, and to continue to fight for transparency and so on and forth. Okay. And this is it. We are nearing the end of our report here. What else did I wanted to show you? So according to us, I already covered that. Dominant market position. Okay, so guys, this was part of my thesis going into the company. Evolution remains the clear global leader in live casino gaming with roughly 45% share versus Playtech's 30% and Pragmatic Play's 25%. And what I'm asking you right now is to be open-minded. What do you think will happen now if this is indeed very true, if Playtech is actually a culprit, if they are found guilty of those negative claims? Do you think they will be able to do more business with few casino providers and so forth? I think not many companies will want to do business with them, and I think that's going to be very positive for Evolution. But regardless, Evolution certainly don't come close to competing with Evolution, because Evolution is far more profitable and it's in a far better market position to continue to create a lot of shareholder value going forward. Okay, they run 1,700 plus live tables for 800 plus gaming operators. So they have been in the business for 20 years. They benefit from the first mover advantage, and I do think that title will not be taken away from them anytime soon, because they know what they're doing, right? They benefit from all that expertise. They know regulations across different markets, and that gives them a moat. Very difficult to breach, if you ask me. Conclusion: so temporary setback, but most importantly, in the long run, tighter oversight will make the industry more credible and attractive to institutional partners. As the market leader in live casino gaming, they are best positioned to capitalize when the regulatory dust settles. You can see here that live for the first time, in fact, RNG for the first time outpaced live revenue growth, as I alluded to before. Profitability took a tumble across the board. Definitely not good to see. I highlighted operating profit right here, because remember that personnel costs went up exactly due to the expansion they are doing. In most of their costs, in fact, most of their operating costs come from personnel costs. And I already covered this. So, and this is the consolidated statement of cash flows. Again, operating cash flow from operating activities took slightly improved from on a quarterly basis. Well, it improved if we compare this to the same quarter in 2024, right? And then this is the cash flow for the period as well, cash from investing activities. One of the things they mentioned that I really like to see is that because revenue has slowed down, they have been cost conscious. And so they understand that they don't want to run up costs too high if revenue is declining. So they want costs and revenue to move in tandem, which is something that I really like to see. Otherwise, that will impact margins, okay? I already discussed that. And now let's talk about valuations. And I never discussed the Buffett's 10x pre-tax earnings rule, but essentially this is a valuation method where investors look to purchase a business for a price that is 10 times its pre-tax earnings. And this already assumes a significant margin of safety, right? Because that business will yield you a 10% pre-tax earnings that can be directly comparable to a bond yield. So where are we if we do that exercise for evolution? And I already done that. So if I go to our stock analysis tool, you can see that trailing 12-month figures, you can see this is the pre-tax income. And remember this, what is the reason behind this method is because Buffett, whether he's buying private companies or publicly traded companies, he always considers he's buying the whole business. And so he's looking for that pre-tax income, okay? Pre-tax income in the case of Evolution is 1.319. This is euros, not dollars, and you have to convert it to dollars. And I've already done that in preparation for this video. And then you have shares outstanding right here. And if you do that exercise, you can see if you divide that by the number of outstanding shares, that gives you a pre-tax earnings per share of 7.50. Now you can divide 7.50 by the current share price of $71, and that will give you a pre-tax yield of 10.5%. What does that mean? It means that if you buy Evolution at today's prices, you are essentially, so if you bought the whole company and if you were able to, so you would essentially put into your pockets, you will be able to put into your pocket 10.5% of its earnings, right? So that's essentially what it means. And it goes to show that the company trades with a significant margin of safety. The market is depressed towards this company. And so you are getting great value for your money, even if we don't assume any growth going forward. This is solely based on the company's current pre-tax earnings. So what we are going to do now with the next exercises is we are going to include some growth, because I do believe this is still a growth company, even though it might not look like in the short term, but I think the future continues to be bright for this business. And so let me share you our intrinsic value calculation spreadsheet. And what is this exactly? So let's start with the payback time. For those of you who don't know payback time, I discussed this already. So the payback time essentially tells you how long it will take you to get your money out of the business from free cash flows. If you bought the whole company today, and we are assuming 10% growth in free cash flows for the next 8 years. Why do we want to recoup our investment in 8 years? Because that is about half the time it takes for an average S&P 500 company to deliver earnings. Remember that the S&P trades, the average PE for the S&P 500 over time is about 16 times, and so 8 times already has a 50% margin of safety built in. Free cash flow per share currently stands at 6. So if we grow 6 at 10% over the next 80 years, and then if you sum up all these free cash flows per share, we get 74. In other words, $74 per share is the price we should pay to get our money back from free cash flows in 8 years, provided the company can grow at 10% at least. And that's the growth assumption that I'm making here, okay? And with the stock currently trading at 71, that certainly meets the criteria. Last but not least, let's discuss our reverse DCF. Look, I have the free cash flows right here, and we are assuming 10% growth, but what the reverse DCF tells us is the growth assumptions currently built into the stock price, and the stock price currently trades at 71, right? Right now we have 84, so we have to lower the growth rate, and if I lower it to 7%, that gives me 71. In other words, the market is assuming that the company is only going to be able to grow its free cash flows at 7% over the next 10 years, which in my opinion is too bearish. I do believe that the company will be able to do much better than that. And even if, as I said, I think the company can grow at 10%, and that is very conservative over the long term. But At 10%, you could even pay $85 per share, and that would already give you a 15% return per year over the next 10 years, which means that you would be able to double your money. You would have two doubles over a 10-year period. Okay, and our minimum acceptable rate of return is always 15%. Cool, guys. Look, I do hope you managed to learn from this video. I'm not buying any more shares at this point because I want to see that the situation in Asia really improves going for. I want to see some signs of improvement before allocating more capital to the business. But I'm not selling any shares either because I'm constructive on the company, and I think management is taking the necessary steps that will set up the company for future success, even though that might take longer than expected. Okay, but as a long-term investor, I'm not in a rush to make money. All right, and I still believe that I'm going to be able to beat the market over time with with investment in Evolution as well. And let me know in the comments what you think, if you are selling your shares and why, if you are buying more and why, and let me know if you found the video insightful and if you want me to create more content like this one. This is already the second company in our portfolio that reports. Next week, PayPal is going to take the stage, right? And that will be the third company in the portfolio to report, and I will keep you posted. In between those calls, I will release more calls, of course. So yeah, just let me know in the comments if you like this one.